was buying houses at the courthouse steps at foreclosure auctions here in California. There was a lot of information you had to keep track of. And everybody else at the foreclosure auction had like a file basket with manila envelopes with different things in it. And there's always papers flying around and people going crazy trying to figure out what's going on. And I realized there had to be a better way. So I sat down and started learning how to write computer code. And so that was it. I figured if nobody else had what I needed, nobody else knew better what I needed than me. So I might as well write it myself. And I had more time than money back then. So that's what I did. So with everybody's situation being different, you just have to look internally at your own situation and determine what your true goals are. What do you really need right now? Appreciation, cash flow, tax benefits. Of course, we all say, oh, I want all of that. But it doesn't quite work that way. There's trade-offs. So you have to decide what's most important to you and make sure that the investment strategy you're investing in is going to provide the most benefit to what your needs are.
Welcome to Generational WealthMD's podcast on financial freedom through investing in real estate. My name is Param Balatandapani. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review. So, Brian, amazing to have you on here. I'm sure most of the people listening know you, but for those of you who don't know Brian is CEO of Praxis Capital, which is a vertically integrated real estate private equity investment firm. And he has acquired over, this number may be off a little bit, Brian, but over $800 million worth of real estate over a 30-year career, including over 4,000 multifamily units and more than 700 single-family units. And how far off are we? Because I think this probably keeps shifting all the time.
I think you pretty close nailed it. That's pretty close.
Excellent. So he's also author of The Hands-Off Investor. It's an amazing guide for anyone who's looking to invest in real estate syndications as a passive investor. I love the book, and we always, refer our investors to the book and have them take a look at it. He talks about the entire spectrum of real estate syndications, pitfalls you need to know, industry standards, and how you can do due diligence as a passive investor. I had the fortune of meeting Brian at the Multifamily Wealth Summit, and I'm so glad he's with us today. I want to start off, Brian, by having you talk about your journey, because I think that in itself is so impressive. So tell us how you got started with real estate investing.
Well, it's kind of a funny story. I was 20 years old when I first got started in real estate investing. I knew nothing about real estate. I had no money. I had no friends in the industry. I had no connections. So I figured I was perfectly set up to be a real estate investor because I wasn't really perfectly set up to do much of anything else. So I started reading a few books about real estate investing, and it sounded interesting. And I thought I'd give it a go. And kind of the rest is history. I mean, I started out as a house flipper. I was flipping houses kind of on a really small scale in the early years, and then scaled up a little bit more as the years ticked on. And I built my business up to about a couple of dozen house flips a year when I started to sense that the market was about to tank. So I stopped buying houses. That was about 2005. And I kind of got out of the business for about 2 or 3 years while the market fell off a cliff, and then jumped back in 2008. And by 2009, I was flipping over 100 houses a year. And I did that for about 5 years. And meanwhile, I decided I needed to build some other kind of business to have a place to put all these investors. So I started a multifamily about 20 years ago, and then never stopped.
That is just amazing, especially when you talk about 100 flips a year. So a lot of people in our community are people who want to own real estate directly, right? Active investors. And I want to unpack a few things. When you say 700 single family homes and 100 flips a year, you're obviously the king of systems, because you can't do that unless you have your systems down pat. So before we talk about that, let's talk a little bit about the no money down investing. How did you get started with that? I think that's one of the most beautiful things about real estate, right? You have the ability to go in and, if you have the time to put into it, then you're able to, create magic. So tell us how you got started.
Yeah, I had no money, so I didn't have a choice. The first property I bought, I got a finance company to finance 80% of the purchase, and I got the seller to finance 20% of the purchase and give me a closing cost credit. So I literally was in it with zero. That was the first one. And then after that, then I got creative in a lot of other ways. And, I would get signature lines of credit from the bank. I mean, it's 10 or $20,000. Every little bit helps. And I could pool the money from the different credit lines. I used to, don't ever do this, but I used to apply for every credit card offer that came in the mail. And then I would get all these credit cards. And so I remember one time I took a stack of credit cards, about 3/4 of an inch thick, down to the bank. I handed them all to the teller and I said, cash advance them all to the max and give me a cashier's check. You're like, are you crazy? And it's like, yeah, I'm a little bit crazy, but just do it. So they did. I walked out of there with a cashier's check. I used that to buy a property to flip another house. So I did anything I could to get started.
That's amazing because it worked, right? It worked. And you obviously knew what you were doing, which is why it worked. But tell us about the systems. I'm sure you started off with like one flip. How did it go from there to like 100 flips a year?
Yeah. So it started out, I was doing onesie, twosie. And then after I've done, I don't know, two or three, 4 dozen flips, I had figured out that I could quit my job and go into real estate full time. So I was in law enforcement at the time. So I put in my 2 weeks notice to the police department and I said, I'm leaving. I do this real estate thing full time. I said to all the guys at the station, I'm like, by the way, I reserved the room at the community center. And if you guys will all come, I'll tell you all about what I'm doing in real estate. So of course they all came because they were all curious. How's this, 20, 30-year-old, quitting his job and leaving to do the real estate thing full time. And so they all came and I told them about what I was doing, flipping houses and how I was financing them, the whole thing. And then I said, look, if you guys will invest with me, I'll split the profits with you 50-50. I'll take investments as low as $5,000. And lo and behold, I walked out of that room with $500,000 in commitments from 28 investors with guns. And I was like, now I have to be really careful because if I lose any of their money, I'm a dead man. But that was my very first real estate fund. And I used that money to grow my house flipping business. And that's how I grew it from, doing a few houses a year to doing 100 houses a year.
That's crazy. Well, first of all, that you were able to raise that much money the first time you went out and raised it. And the fact that you were using creative financing and then eventually other people's money to start scaling. But tell us a little bit about all the systems that you had to build to take it to that volume of transaction that you were doing. Was that just like organic? It just happened?
It was hard. It was really hard because when I first started in this business, this was, in the early 1990s. And the way I did this business, I was buying houses at the courthouse steps at foreclosure auctions here in California. And you have to pay with cashier's check, right? In full at the time of your bid. So that's why I had to raise money from investors in order to do this. But the other thing is the method of tracking all this stuff was very archaic. You'd find out about the notices by seeing the legal notice in the newspaper. And then you have to keep track of when the sale is. And then if it postpones, you have to keep track of the new date. You have to research the title and know what liens are on title. Is this a first going to sale, a second, a third? Are there IRS liens or other liens? There was a lot of information you had to keep track of. And everybody else at the foreclosure auction had like a file basket with manila envelopes with different things in it. And there's always papers flying around and people going crazy trying to figure out what's going on. And I realized there had to be a better way. So I sat down and started learning how to write computer code. And I actually wrote my own software that would allow me to track foreclosure auctions, put in all of the data for foreclosure auctions, do my title searches, enter all the data for all the title searches, where it would automatically prioritize if the lien was first, second, third, or whatever. If there's other liens, it would subtract all that stuff from the max bid and just did all kinds of stuff. In fact, I still use that to this day, by the way. And so that was it. I figured if nobody else had what I needed, nobody else knew better what I needed than me. So I might as well write it myself. And I had more time than money back then. So that's what I did.
That's crazy that you actually wrote your own code. But yeah, so you're an entrepreneur at heart, Brian, not just a real estate investor. So that's very entrepreneurial on your part. That's amazing. Well, tell us how you shifted from, I'm assuming you were doing a lot of those flips in California, right? So how did you shift to becoming an out-of-state investor? What made you have to transition? And then why the shift to multifamily?
Well, if it was '05, so those are two different questions. The shift to multifamily actually happened sooner than that. But in '05, I realized that California real estate made no sense. I would go to real estate club meetings and investors would come up to me and they would say, I want to buy a rental house. I gotta find a rental house. And I would say to them like, why? They're $500,000 and the rents are $1,500 a month. Why do you need to buy this rental house so badly? Oh, because My neighbor, he's a plumber and he bought this house and it went up in value $1 million. He made more money doing that than he did plumbing and blah, blah, blah. So I've got to do it too. And I thought, oh boy, this is going to be a problem, right? There's going to be massive headache
Hmm.
chaos. There's going to be tons of foreclosures for me to buy, but I want no part of what's going on right now. So that's when I essentially stopped buying real estate and decided like, I need to maybe look in another market. Where could I go where prices have not run up? Like in California, by this point, prices had gone way high. Where can I go where they haven't done that? So I came upon Buffalo, New York, of all places. I'm like, the values have never gone up. The property's been the same value for years. So if I buy a property there, I could actually get cash flow and forget about the appreciation. I don't need that. What I don't want is depreciation. I
Hmm.
didn't want property values that went down. So I bought an 11 unit apartment building there.
Okay.
And that was my first out of state investment. And it was apartments because I had gotten into apartments a few years earlier on a 1031 exchange here in California.
Makes sense. Makes sense. Economies of scale. Do you still invest in Buffalo, New York?
Actually, I don't actively invest there, but I still to this day own that property that I bought out there, like, I don't know, 15 or 18 years ago.
And it's probably worth a lot more than it was even in that market.
Yeah, this is an 11 unit building. I think I paid like 300 for it,
Hmm.
and it's worth well over $1 million now.
Yeah. Yeah. That's, yeah, sounds about right. Brian, you have been the master at timing cycles, and I know you've already been through one cycle, one real estate cycle, right, with the '05 downturn. Tell us a little bit about how you're pivoting right now with what you're doing and, what changes you're seeing in the market right now.
Yeah, timing is really important. People like to say, just buy real estate and wait, right? And it'll always go up in value. And that may be true, but if it goes down in value by 20%, and then you have to wait for it to go back up, you could go a decade just to get back to even. So timing really is important. I've been through several cycles. I went through the 2000 dot-com bubble burst, which didn't have a huge effect on real estate, but did have some effect on the economy. I went through the '05 to '07 great financial collapse, that had a devastating effect on real estate. Went through the '09 climb and then the 2010 decline after there was like a first time home buyer tax credit. So there was like a double dip in the market. So went through the double dip, navigated that pretty well. And then, of course, the COVID run up.
Yeah.
That was an interesting time. But I think timing has always been really important. I got out of the, heavy buying in about '05, right before the collapse. I got back in 2009,
Hmm.
and then by 2010, I came up with a thesis that home prices in California were going to double in 5 years. So I'm like, I'm going to start buying houses to rent out. So I went to a family office conference and I was talking about, I'm shifting from this buy and flip strategy to a buy and hold strategy. And this guy came up to me after the speech and he was like, "You're crazy. You don't know what you're talking about. This is the worst time to buy houses to hold. This is the time to be in the flipping business, yada, yada, yada." But I stuck to it and bought 120 rental houses in the San Francisco Bay Area
Hmm.
in, '09, 10, 11, which by 2015 not only doubled, but doubled in a half, and then sold them at, a great time to get out and had a really nice profit on that. And then started buying multifamily heavily in about 2016, 17. And then 2021, I started to sense that the market was topping out. So I figured it was time to get out. So had about 4,000 multifamily units, but from 21 to early 22, I sold three quarters of them. Sold
Hmm.
about 3,000 multifamily units. Also sold one of my companies in middle of 2022. So
Is that the
basically
lending, the
the
lending
lending
arm?
company. Yeah, I sold that. So I basically almost got completely out of everything middle of last year. And then the, rug got pulled out from under us and I couldn't be more happy with that decision.
Yeah. What does your direct ownership portfolio look like right now? Or do you still have any single family homes in there, or is it all multifamily?
Yeah, I have a mix. Actually, I have a couple single families, quite a few small multis in my personal portfolio, around 40, probably 40 or so units.
Hmm.
And then in our syndication portfolio, I've got still about 800 or 900 units left.
Okay. And then the plan is to hold them and weather the cycle.
Yeah, exactly. These are ones I kept intentionally because they were Class A properties in a great market,
Yeah.
and I think that
Cash
those are,
flowing.
yeah, that's right, and those are worthy of holding on to.
Yeah.
And we sold out of everything else.
Makes sense. Makes sense. Brian, a lot of our members on here listening to us invest in syndications already or are considering investing in syndications. And I know in your book you talk about how even within the real estate syndication space, there's a whole spectrum as far as risk and, return profiles in terms of cash flow and velocity of growth. And I always think the first step is identifying what your goals are and what makes sense to you. So you're not looking at everything as a shiny object and getting attracted to it. Can you kind of demystify that a little bit? Okay, what do they need to think about in terms of their goals before they even start looking at opportunities that are presented to them?
Yeah, everybody's personal situation is different, right? So we have a lot of physician investors, for example, who would say, I'm making great money. I have no time to chase down real estate and I don't really need more income. They're looking really at the depreciation or getting, income or cash flow with depreciation to offset the tax. So, for a lot of high income earners, it's a bit of a tax and appreciation play. For retired people, it's all about cash flow. Appreciation, sure they care, but they don't really care. I mean, they want to
Yeah.
see cash flow. Young people tend to want appreciation prioritized over cash flow because they want to build an asset base so that when they are older, they have assets to invest that will generate cash flow. So, with everybody's situation being different, you just have to look internally at your own situation and determine what your true goals are. What do you really need right now? Appreciation, cash flow, tax benefits. Of course, we all say, "Oh, I want all of that." But it doesn't quite work that way. There's trade-offs. So you have to decide what's most important to you and make sure that the investment strategy you're investing in is going to provide the most benefit to what your needs are.
Yeah. Yeah. Absolutely right about that. So, Brian, cap rates are beginning to decompress a little bit. We're seeing lending constraints, transaction volumes lowering. Which multifamily assets do you think are probably most likely to face distress right now? Because I feel like all of them are not going to be the same. So where are you seeing the most distress? What do you anticipate?
The most distress is going to come actually from owners who didn't finance properly. People who got short-term bridge loans that have maturities coming up, maybe over leveraged where when they bought it, they were at, 70 or 80 to 90% loan to value ratios. Those are going to be where you see the heaviest distress, and that's going to fall all the way across the commercial real estate spectrum. There's people that were buying Class C and D properties with short-term bridge financing, and there were people buying A plus new construction properties with short-term bridge financing.
Yeah.
So in that respect, you're going to have all sectors of residential income real estate affected. Outside of that, structure aside, I think your Class C properties are probably going to feel the biggest pinch, probably from lack of collections. Those are going to
Which
have
is
some
contrary to
impact.
what you hear people say. They always
It
say
is,
Class B and C tends to be recession resilient.
yeah, and that's just hogwash. I have not seen that in
Yeah.
actual
Yeah.
practice. In my experience, it's been the exact opposite. People will have the thesis that people will downclass.
Yeah.
So the Class B people will move to Class C, Class A people will move to Class B, Class A is empty, and Class C is always full. That's not the way it works. I mean, if somebody lives in a Class B property and times get tough, they're actually more inclined to take on a roommate and double up, or
Yeah.
maybe even double up an up class and go to Class A before they're going to go into a Class C property. And the Class C people will hang out there until the sheriff shows up. So you're going to have collection issues. So I've had a lot of bad luck with Class C.
What states do you invest in, Brian? Just curious to know. Praxis Capital, do you focus on, the Sun Belt, landlord friendly states? And
Yes, I would say mostly Sun Belt red states, your southern, Arizona, Texas, Georgia, Florida, Carolinas,
yeah,
Tennessee. Those are high on our target list right now with what's left of our portfolio. We own in Arizona, Georgia, and Alabama.
perfect. Brian, I know you said you're sitting on the sidelines for a little bit. So when would you know that it's time for you to start jumping in? What's your criteria?
Yeah, I haven't bought anything in over a year and a half and probably won't. Well, we've done a few house flips here and there because it's interesting. There's some opportunities out there in small real estate right now.
Mhm.
So single family house flips, single family rentals, small multi, duplexes, fourplexes, fiveplexes where you have troubled owners, that kind of stuff. You can find one-off deals in that space, but in the large multi space, I'm completely standing off right now. I think, values have fallen probably 20%. I think that's the tip of the iceberg. They're only really showing how far the true value has actually gone down given where we are today. So I think we have more pain before we start to see gain.
For those flips that you're doing right now, is the plan to hold them if you need to in the event that you aren't able to sell? Or, which markets are you doing those in where you feel like you're still comfortable doing that?
Yeah, locally here in California, where the markets are really quite strong. In fact, most of the flips we're doing, we're getting multiple offers above
Yeah.
asking price within days, if not weeks, of listing it. So our plan is not to hold them. If I feel that we're going to have to hold a property because we might not be able to sell it, I'd rather just not get into it and buy it in the first place.
Makes sense. And we've seen that I think it's in many markets throughout the country. Inventory is so low that, home prices have stayed high. It's still a, seller's market over here.
Yeah, in a lot
So,
of markets it is, but there's also another thing that people need to keep in mind when they're house flipping is that some house flippers, they rely on home appreciation in order to make a profit. And I don't do that. We have to be able to make a profit if the value doesn't move at all. Even if it moves down a little bit, we at least have to be able to break even. So we don't have to have momentum in the market in order to be profitable. We won't buy that high.
yeah.
So that's a distinction. That's why, like I said, if we don't think we can sell it, make a profit, even at a little bit less sales price, then we're not buying it.
And so these are distressed assets that you usually acquire.
Foreclosures from the courthouse steps. Yeah. So distressed in that regard. But I mean, literally some houses you walk in and it's like paint and carpet and you're out of there.
Yeah.
Those are pretty rare and few and far between. They were every day we were buying those back in the day. But these days they generally need a little bit more work than that.
Absolutely. So before we wrap it up, Brian, what is your advice to investors who are investing passively in syndications when they're looking at deals right now? What do you think they should keep an eye out for? I think you kind of covered it, but like just to summarize everything.
Well, I think the most important thing you need to look out for is the sponsor that you're seeking to invest with. People ask me all the time, like, how do I find a deal to invest in? And it's like, well, you start by asking the right question, because where do I find a deal is the wrong question. What you really need to be asking is, how do I find investment sponsors that I can invest with that will be a long-term partner for me? Because that's really where the rubber meets the road. You can
Yeah.
find a good deal and some screw up sponsor can mess the whole thing up. So it's really all about finding the right syndication sponsor that's been through market cycles, been through tough times, really knows what they're doing, and is finding good deals. And if they're buying stuff right now, I don't know, I'd take a really close look, because I can't find an excuse to buy anything right now. So that might be cause for concern or a red flag.
We've pivoted as far as acquisitions to, it's more like a flight to safety where we're doing cash flowing assets day one, more like class A minus, loan assumptions that have a 7-year term left on them, things like that. But I agree, it's just got to be very cautious right now.
Timing and the way you finance are critical. I think you're
Yeah.
very smart for looking at loan assumptions right now. That's a great way to look for things at class A minus. That's the only thing that I'm buying right now
Yeah.
if I were to buy, the only thing we're looking at right now is really, A minus, maybe B plus assets.
Exactly.
We're really looking at stuff built after 2000. That's, to me, it's a flight to safety.
Sounds good, Brian. Now, if anyone wants to get in touch with you, how would they get in touch with you? And guys, we're going to drop in the show notes the link to Brian's book and to the website. But if you wanted to give them additional information, Brian.
Yeah, they can always find us on our website. Our company's Praxis Capital. The website is praxcap.com. It's praxcap.com.
Thank you so much, Brian.
Thanks for
I'm taking
having
a
me.
look here. I don't think we have any questions, just thank yous from a lot of people. So thank you so much for making the time, Brian.
Yeah, it's my pleasure. Thanks for having me here.
If you're interested in learning how to invest in long-term and short-term rentals the right way, so you can accelerate to financial independence with the support of mentorship, community, and vetted investor agents in strong markets across the country, then get on the waitlist for the next cohort of Creating Generational Freedom at www.generationalwealthmd.com. You don't have to learn from decades of costly mistakes by yourself. The program is only open for enrollment in the spring and fall each year. In the last 6 months alone, our members have acquired over $60 million of real estate, and more importantly, they're living life and practicing medicine on their terms. You don't have to do it alone.